Hello everybody, this is Ashwant. I'm here to take the tech talk presentation on about concept of joint stock company. Let's discuss some about its definition and some of the there are some case studies, small case studies included in the presentation. We will walk through the each topic in few minutes. Let's start with an introduction of the joint stock company. A company whose let's know the definition of what the Georgetown company means. A company whose shares can be bought and sold by shareholders. A Georgetown company is a business entity in which shares of the company stock can be bought and sold by shareholders. Shareholders have a limited liability, meaning they are not personally responsible for the company debts. Like if they means this concept they will get more profits when the company is profit more in the when they're in the high profits, but they get the lower risk when the company is in loss. That's the meaning of the Georgetown company is talking about. Georgetown companies are a popular form of business organization due to the ability to raise a large amount of capital. Yes, because the shareholders do not have much more pressure on when the company is on loss, but they can enjoy the more profits when the company is in the profits. Now let's talk about some history of joint stock companies. The concept of joint stock companies dates back to the 17th century with the formation of the Dutch East India Company. And there is some types of joint stock company. They are categorized into three types: the chartered company and registered company and statutory company. In the registered company there are two companies, limited company and unlimited company. In the limited company we have two things, like limited by promise, limited by share. And in the limited by share we have two limits, that is public limited and private limited. The joint stock company played a crucial role in the development of a global trade and colonization. Today joint stock companies are prevalent in various industries from technology to finance. Now let's talk about the legal structure of the joint stock companies. As we discussed, that it's look like this. Joint stock companies are registered entities with a separate legal identity from their shareholders. Shareholders can elect a board directors to oversee the company's operations and make key decisions. The company articles of association outline the rights and responsibilities of shareholders. It's like shareholders can elect the board of directors to when the important decisions of the company has to take, like investing, or when how to increase the shareholder, when how to invest the company in much more profit. Like these are the discussions uh, made by the some of the board directors, so which are elected by the shareholders. So now let's talk about some advantages of joint stock companies. It has the ability to raise capital through the sales of shares. Yes, uh, through this joint stock company, we can raise some of the capital with less risk. Unlimited liability protects shareholders from personal financial risk. As we discussed that, um, like company profits are very high, they can enjoy the personal shareholder finance much more. But when the company is in loss, the the total burden is not upon the shareholders, but there is some personal finance risk is there in the shareholder. So this is the best option for the looking for the Georgia companies who's for the shareholders. And shareholders have the opportunity to participate in the company's profit through dividends. As we discussed, they can enjoy the more profits with the less risk. Uh, there is a disadvantage of joint stock companies. It's like every side of the there is a flip of the topic. Here there are some shareholders may have limited control over the company operation because they are already elect some board directors to take over all the decisions. So they have some shareholders have some limited company operations. Regulatory compliance requirements can be complex and costly. Shareholders are exposed to the risk of market volatility affecting the value of the shares. Now let's talk about some financial analysis of chart stock companies. Financial analysis involves evaluating a company's financial performance and position. Here is some of the financial chart. Here in this financial analysis, we have two categories like test of profitability and test of financial health. Test of profitability is like debt ratio, at current ratio, correction period, and test of financial health is about return on sales, inventory turnover, and some more. And some let's discuss some about the key financial metrics include like revenue and expenses, profit margins, and debt levels. These are the key in the topics in the financial analysis to understand the what the how the trends of the company is here in the market. Investor uses financial analysis to make informed decisions about buying or selling shares. Yes, this is a best strategy by used by the shareholders or any investors to invest their money in the company or through shares. In the financial After the financial analysis, uh, mostly of the shareholders or investors are looking about the financial statements. The joint stock companies are required to prepare financial statements including the income statement, balance sheet, and cash flow statement. In this among these three statements are very important in the analyzing the financial analysis. These statements provide a snapshot of the company's financial health and performance. It's a balance sheet is talk about like there is assets plus liabilities. In one statement, the there it is an assets and liabilities. In the assets we have long term assets and short term assets, and also in the liabilities we have short term liabilities, long term liabilities. By looking through this, they can invest some more, can buy the shares of the company. Investors and analysts use financial statements to assess the company's profitability and financial stability. To know the financial stability of a company, they will look after these three sheets that are nothing but income sheet and balance sheet and cash flow statement. Now let's discuss some about the ratio analysis types. Liquidity ratio. They are the. Let's discuss some of the what is ratio analysis. Ratio analysis involves calculating and interpreting financial ratios to assess a company performance. In the ratio analysis types, there are the five types of ratios, that is the liquidity ratio and profitability ratio, solvency ratio, and turnover ratio, earning ratio. In the liquidity ratio we have current ratio and quick ratio. Profitable ratio we have gross profit ratio, operating profit ratio, net profit ratio, return on capital employed. In the solvency ratio we have debt equity ratio, interest coverage ratio, and in the turnover ratio we have fixed asset turnover ratio, inventory turnover ratio, receivable turnover ratio. In the earning ratio we have two, that is there are profit earning ratio, earning per share ratio. But among these all, we have common ratios at debt to equity ratio, return on equity, earnings per share. Ratio analysis helps investors compare companies within the same industry and make investment decisions. Now let's discuss some about the stock valuation. Stock valuation is the process of determining the intrinsic value of a company shares. Methods of stock valuation include discounted cash flow analysis, price earning ratios, and dividend discount model. Stock valuation helps investors are undervalued or overvalued. Investment strategies. Investors can adopt various strategies when investing in stock companies such as value investing or growth investing. Diversification is key to managing risk and maximizing returns in stock portfolio. And long-term investors may focus on fundamental analysis and companies' growth prospects. In this case study, we will take the best well-known company, familiar company, that is Apple. Apple is a well-known joint stock company in the technology industries. The company stock has delivered strong returns to shareholders over the years. Apple financial performance, products innovation have contributed to its success in the market. Now let's talk about some of the case study in the Tesla. Tesla is a joint stock company known for its electrical vehicles and renewable energy resources. The company stock has experienced a significant volatility due to market expectations and production challenges. Tesla growth strategies and CEO Elon Musk leadership style have influenced investor sentiment. And there are the mapping Tesla strategies. first set a vision what you want, and then invest resource in a strategic program, then focus on an identified opportunity, then leverage breakthrough market impact, then finally we have the performance result that pays back. At the conclusion, that an organization, joint stock companies, an organization created to pool the resources of the merchants. These distribute the cost and risks of colonization. This also reduces the danger to individual investors, because the more of the profits are earned by the shareholders, but not the total risk are earned by the individual investors. The financial analysis is essential for evaluating the performance and value of a joint stock companies. Investors should conduct through research and analysis before making investment decisions in the stock market. And this is about. Thank you for all for the attention and interest in the concept of joint stock companies. If you have any questions or would like to learn about more of this topic, feel free to reach out. Thank you.